Today we're diving into International Accounting Standard 16, or IAS 16, which is a cornerstone in financial reporting for businesses worldwide. The standard sets out the principles for recognizing, measuring, and disclosing property, plant, and equipment, often referred to as PPE. Understanding IAS 16 is crucial for anyone involved in accounting or finance, as it ensures consistency and transparency in how companies report their tangible asset. Throughout this video, we'll break down the objectives, scope, definitions, and key criteria of IAS 16, making the complex world of accounting standards much more approachable. Let's start with the objective of IAS 16. The main goal of this standard is to prescribe the accounting treatment for property, plant, and equipment. It ensures that users of financial statements can understand the investment a company has made in its tangible assets and how these assets contribute to future economic benefits. By setting clear guidelines, IAS 16 helps companies present a true and fair view of their financial position, which is essential for investors, regulators, and other stakeholders. IAS 16 applies to all property, plant, and equipment except when another standard requires or permits a different accounting treatment. For example, assets classified as investment property or biological assets are covered by other standards. The scope of IAS 16 is broad, covering everything from office buildings to machinery and vehicles. By defining what falls under its umbrella, IAS 16 helps companies avoid confusion and ensures consistent application across industries. Now let's define property, plant, and equipment, commonly known as PPE. According to IAS 16, PPE are tangible items that are held for use in the production or supply of goods or services, for rental to others or for administrative purposes, and are expected to be used during more than one period. This means PPE includes things like buildings, machinery, vehicles, and office equipment, assets that help a business operate and generate revenue over time. PPE assets have two key features. They're tangible, meaning you can physically touch them, and they are used in the business for more than one accounting period. These assets are not intended for sale in the ordinary course of business. Instead, they support the company's operations, whether it's a delivery truck transporting goods or a factory machine producing products. Understanding these features helps distinguish PPE from other asset types. For an item can be recognized as PPE on the balance sheet, it must meet specific criteria set by IAS 16. Recognition means recording the asset in the company's financial statements. The standard outlines two main criteria: probable future economic benefits and reliable measurement of cost. Let's explore what each of these means in detail. First recognition criterion is that it must be probable the asset will bring future economic benefits to the company. This means the asset should help the business generate income, reduce costs, or otherwise contribute positively to operations. For example, a delivery van enables a company to reach customers efficiently, while a production machine increases output. If an asset doesn't offer such benefits, it shouldn't be recognized as PP. Second recognition criterion is the ability to reliably measure the cost of the asset. This means the company must be able to determine how much was spent to acquire or construct the asset, including any costs necessary to bring it to its intended use. Without a reliable cost measurement, it's impossible to accurately reflect the asset's value in the financial statements. This ensures transparency and accuracy in reporting. Let's look at some examples to clarify what qualifies as PPE and what doesn't. A company's office building, manufacturing equipment, and delivery vehicles are all PPE because they're tangible, used in operations, and provide future economic benefits. On the other hand, inventory held for sale, intangible assets like patents or investment properties are not classified as PPE under IAS 16. Understanding these distinctions helps ensure correct classification in financial statements. Capital expenditure, or CapEx, refers to spending on acquiring or improving PPE. These are costs that provide benefits over multiple periods, such as purchasing new machinery or upgrading an office building. CapEx is capitalized, meaning it's recorded as an asset on the balance sheet and depreciated over time. This approach matches the cost of the asset with the periods it helps generate revenue, providing a more accurate picture of profitability. Revenue expenditure, on the other hand, includes costs that are incurred for the day-to-day running of the business and do not provide long-term benefits. Examples include repairs, routine maintenance, and utilities. These expenses are charged directly to the income statement in the period they're incurred. Distinguishing between capital and revenue expenditure is essential for accurate financial reporting and compliance with IAS 16. It's important to clearly distinguish between capital and revenue expenditure. Capital expenditure results in the acquisition or enhancement of PPE and is capitalized, while revenue expenditure relates to maintaining the current condition of assets and is expensed immediately. For example, buying a new delivery truck is capital expenditure, but repairing an existing truck is revenue expenditure. This distinction affects both the balance sheet and the income statement. Once recognized, PPE is depreciated over its useful life. Depreciation allocates the cost of the asset over the periods it benefits, reflecting wear and tear or obsolescence. This process ensures that the expenses match with the revenue generated, providing a realistic view of profitability. The method and rate of depreciation should reflect the pattern in which the asset's economic benefits are consumed. IAS 16 also sets out disclosure requirements for PPE. Companies must provide information about the measurement bases used, depreciation methods, useful lives, and any restrictions on title. These disclosures help users of financial statements understand how PPE is valued and managed, supporting transparency and informed decision-making. Wrap up: IAS 16 provides a comprehensive framework for accounting for property, plant, and equipment. By defining what qualifies as PPE, setting recognition criteria, and distinguishing between capital and revenue expenditure, the standard ensures consistency and transparency in financial reporting. Understanding IAS 16 is essential for accurate asset management and compliance with international accounting practices.